Okay, we are now joined by Anthony Chan, the former chief economist at JPMorgan Chase, to dive a bit deeper into these numbers and what they mean about the economy. Anthony, thanks so much. Good to see you again. A weaker than expected jobs report, but Wall Street and market watchers certainly happy. So kind of break it down for us. Is this indeed a good sign for the Fed, as many are saying, or do you think perhaps some people are reading too much into this?
I think it is very good news, Sean, because what you see is that when you look at the 3-month average of these numbers, we're looking at 242,000. That's certainly much weaker than we had seen in the last couple of months. And it does tell you that some of that pressure on employment will, in fact, sort of push into lower wages. And the wage numbers did not disappoint. Now we're looking at average hourly earnings on a month-over-month basis rising 0.2%, which again tells us that on a year-over-year basis, we're below that critical 4%. And let's not lose sight of the fact that we are now seeing some evidence that productivity may be picking up. So if productivity is picking up and wage pressures are going down, that is exactly music to the ears of the central bank. And that is why the Fed futures market is now pricing in as much as 2 rate cuts between now and the end of the year, particularly as we approach the last couple of months of this year. And that, I think, is telling you that they expect inflation pressures to come down, but also justification for action.
You know, Anthony, as you mentioned, the unemployment rate still remains below 4%, but this is the first time in recent months that job gains have cooled. So do you think this is a sign that the Fed's efforts are working, or perhaps finally working, as some people perhaps have complained about? Or are there other factors out there as well? You talk about the productivity going up and the pressure down on wages.
Well, it's really a combination of all these factors, Sean. Remember that the peak consumer price index was 9.1%. We are now seeing inflation coming down. Still, the residential rent, sheltered rent is still a problem. But we know that the Bureau of Labor Statistics also produces a new tenant rent index. And if you use that one, the headline CPI actually moves all the way below the 2% already. The problem with the CPI right now, that it has that hodgepodge of rent leases, old rent leases which are higher and the new ones which are lower, but it puts them together. If you just use the new rent indices, like a lot of the market companies tell you, the numbers are much, much weaker. So we are moving in that direction. Have we seen bump in the roads? Of course we have. Inflation is a little stickier, but Sean, there is no debate whatsoever that the trajectory is lower.
It certainly sounds like such good news. Well, what about where the jobs are? Because I've heard some economists critical that, look, a lot of this jobless rate is focused on service sector jobs. And if you're right, productivity is showing signs of gaining life again, then that certainly seems to be great news out there and exactly what the administration, the Fed, has been pushing for.
Well, we are seeing that the goods sector is not as robust as the service sector. But Sean, you saw the manufacturing jobs moved into positive territory. You now had 8,000 jobs in manufacturing. The month before that, you had minus 4,000. But again, the service sector is where people are spending money. That's where you're going to see the number of jobs being created. You can't turn that around. And that's one of the reasons why it's been so hard to lower wage pressures, because I think everybody knows that it's much harder to boost productivity in the service sector than it is in the goods sector. It's happening, but it's much more challenging.
So what about wages? Are they growing, and what does the information show from that? Because there are a lot of people out there who feel they have to work 2 jobs, 3 jobs, certainly both breadwinners in the family out there every day.
Well, wages are in fact slowing. The question that you're asking is more fundamental, and that is, are people making enough money in order to support themselves? And the answer is that's been a big challenge. Income inequality, I've done some work on this, is actually getting worse. And when income inequality gets worse, it gets more challenging. It's no secret that more women are working and have been working because they have to. It's not so much because they want to, they have to. It's a much more challenging environment. And again, as there's been globalization and you've seen those pressures enter the system, it has meant that the returns to labor are much weaker. We know that the number of people belonging to unions has come down dramatically over the last couple of decades. Yeah, we increased a little bit recently, but again, not enough to move the needle.
Okay, so you probably heard the economist in the story before you say that he doesn't think the Fed is going to move on interest rates this year. What other information, what other data is out there? What are the Feds going to be looking at? And you seem a lot more optimistic.
I do, because certainly even the Fed chair is basically telling us that he's ready to lower interest rates. What he needs is justification, and the justification will come from the data. This report certainly is a step in that direction, but it's still not a complete step. You need to see one or two more of reports like this following this one in order to give the Federal Reserve the confidence to lower interest rates. They want to do it. They need the data to justify. So we get one or two more reports like this, the Fed will lower rates. If the data all of a sudden goes rogue and we don't get other employment reports or inflation reports supporting what we saw today, then again, the Fed waits a little bit longer. But I think one of the good things that we've heard from the Fed chair is that they've basically almost taken rate hikes off the table. And what they're telling us, they're going to be patient, but they're looking for justification to lower the rates. Today's report was one of those steps, sealed one of those steps in terms of justifying lower rates, but we need to see more.